Every dollar in your wallet is somebody's debt. Every coin. Every digital number in your bank account. Money doesn't exist until someone borrows it into existence. It's not a metaphor. That's how the system actually works. But if all money is debt, and debt means someone owes someone else, then there's a line, a hierarchy. When things go wrong, when banks fail, or governments collapse, someone gets paid first. Someone gets paid last. And most people, the ones who think their savings are safe, discover too late where they actually stand in that line. This is the financial historian, where money, power, and history collide. And nothing is ever as simple as it looks. Today we're answering the question nobody wants you to ask. If money is debt, who gets paid first? The answer reveals who really holds power in the financial system. Understanding money means understanding priority. Not who has the most, but who gets paid when there isn't enough for everyone. That's where the real power lives. Most people believe their bank deposits are their money. They're not. Legally, they're unsecured loans you've made to the bank. When a bank fails, you become a creditor, standing in line with everyone else. And here's what they don't teach you in economics class. That line isn't random. It's designed. There's a pecking order built into the system, and it's been this way for over 300 years. To understand the hierarchy, we need to go back to 1694. England is fighting France. The king needs money, but the treasury is empty. So he makes a deal with London merchants. They'll lend him money. In exchange, he gives them something revolutionary, the right to issue banknotes backed by that debt. This creates the Bank of England, the first modern central bank, and it establishes a new kind of money. It's not gold coins that hold value in themselves, but paper notes that represent debt. The note in your hand is a promise. Someone owes something to someone. For the first 200 years, these notes were still backed by gold. If you didn't trust the paper, you could exchange it for metal. But in 1971, President Nixon ended that connection. Gold backing disappeared. From that moment forward, money became pure debt, with nothing behind it except trust. Today, when you deposit money in a bank, the bank doesn't store it in a vault. They lend most of it out. When someone takes a loan, the bank doesn't give them depositors money. They create new money by typing numbers into an account. That loan becomes a deposit somewhere else. Money is created the moment debt is created. This is called fractional reserve banking. And it means the entire money supply is really a web of IOUs. Every asset on one balance sheet is a liability on another. The system only works if everyone believes they'll get paid. But when belief breaks, someone has to lose. Here's how it actually works. You walk into a bank and ask for a mortgage. The bank checks your credit, verifies your income, and approves the loan. Then they don't go to the vault and count out cash. They create a new deposit in your account. The money didn't exist until you borrowed it. Now you have a debt to the bank, and the bank has an asset, your promise to repay. The bank's balance sheet grows on both sides. More assets, more liabilities, money supply just increased. When you pay back that mortgage over 30 years, the principal disappears back into nothing. The interest is what the bank keeps as profit. In other words, the money supply constantly expands and contracts based on lending activity. Central banks sit at the top of this system. They create reserves that commercial banks use to settle transactions between each other. But about 97% of all money in circulation isn't created by central banks. It's created by commercial banks making loans. That's the secret nobody explains clearly. Money isn't printed by governments and distributed. It's loaned into existence by banks and only exists as long as the debt exists. So if money is debt, and debt has a creditor and a debtor, then when the system breaks, who gets their money back first? That's not a philosophical question. It's a legal one. And the law is very clear about the order. When a bank fails, there's a legal priority list called the creditor hierarchy. It determines exactly who gets paid in what order from whatever assets remain. Here's how it works from top to bottom. First in line, Central banks. If a commercial bank owes money to the Federal Reserve or the European Central Bank, that debt gets paid before anyone else touches a dollar. Central banks are the lender of last resort, and they always get made whole. Second, secured creditors. These are institutions that lent money backed by specific collateral. If you pledged your house as security, the lender gets the house before anyone else can claim it. Big institutions secure their loans. You don't. Third, unsecured creditors with seniority. These are bondholders and large institutional lenders who have legal seniority written into their contracts. They're still unsecured, but they're ahead of everyone else in line. Fourth, general unsecured creditors. Now, this includes smaller institutions, suppliers, and sometimes large depositors above the insurance limit. Fifth, insured depositors. In the U.S., the FDIC insures deposits up to $250,000. If your bank fails, this insurance eventually pays you, but you're still below secured creditors and bondholders. Sixth, uninsured depositors. If you have more than the insurance limit, that excess money is unsecured debt you've loaned to the bank. You get whatever's left after everyone above you gets paid. Often, that's nothing. Last, equity holders, the shareholders. They get wiped out first because they took the risk of ownership. Notice what's missing from the top of this list. You, the average depositor who thought their checking account was safe, you're in the middle at best, near the bottom at worst. And this isn't theory. This hierarchy gets tested every time a bank fails. And it's always the same people who get paid first. In 2008, the global financial system nearly collapsed. Banks around the world were failing. Lehman Brothers went bankrupt. AIG needed a government bailout. The entire system was breaking. Who got paid first? Central banks and large institutional creditors. The Federal Reserve created trillions in new money and funneled it to banks to keep them solvent. Bondholders were protected. Shareholders lost value, but banks themselves survived. Who got paid last? Homeowners? Millions lost their homes to foreclosure. Retirement accounts collapsed. Jobs disappeared. But the banks that caused the crisis got rescued because they were at the top of the payment hierarchy. In 2013, Cyprus provided an even clearer example. The country's banks failed. The government didn't have enough money to bail them out, so they did something unprecedented. In 2023, Silicon Valley Bank collapsed. Depositors panicked. The government stepped in and guaranteed all deposits, even above the insurance limit. But that decision was political, not legal. Under normal rules, uninsured depositors would have stood in line and waited like everyone else. The pattern is always the same. When crisis hits, the people at the top of the hierarchy get protected. The people at the bottom absorb the losses. Banks get bailed out. Citizens get told to tighten their belts. This isn't conspiracy, it's design. The financial system is built on confidence. If depositors panic and withdraw all their money at once, banks collapse. Banks collapse, the economy freezes. If the economy freezes, everyone suffers. So the system protects banks first because banks are the foundation. Central banks get paid first because they stabilize the system. Secured creditors get paid first because that encourages lending. The hierarchy exists to prevent total collapse. But here's the uncomfortable truth. This design protects institutions over individuals. It prioritizes system stability over personal fairness. When you deposit money in a bank, you're not storing wealth, you're lending it. And lenders always take risk. The question isn't whether the hierarchy is fair, it's whether you understand where you stand in it. If money is debt, someone always owes, and someone always collects. The hierarchy determines who survives when the system breaks. If this changed how you see your bank account, hit subscribe. History has the answers. I'll show you where to look.